conclude our speaker presentation, we now move to trading and price discovery perspective. It's my pleasure to invite Mr. Ameya Bhagwat, Product Manager, Base Metals MCX. He will enlighten the gathering with the lead trading trends and price discovery on MCX. Ameya, to you. You are the last one to capture I think we are just on time. I must appreciate everybody had stuck to the timing, so we are able to complete all the participants' presentations. Come on, Amya, over to you.
Yes, thank you very much, ma'am, Vidana, and thank you very much for this opportunity to speak on this forum. I hope my screen is visible right now.
The screen is fine.
All right, good afternoon, everyone. I would like to discuss a bit about lead trading trends and price discovery on MCX. To start with, let me give you a brief about what the lead contract specifications and what type of lead ingots are accepted at MCX. We have two contracts, lead and lead mean, which trade at a quantity of 5 tons and 1 ton lot, with a minimum quality of 99.98%, which is actually higher than any other accepted brands in any other exchanges. The quotation value is 1 per kg basis, rupees per kg, from X warehouse, X Chennai, where we have our primary delivery center. We also have an additional delivery center in Palwal to cover for the north and south regions lead market. Delivery is also done in 5 tons and 1 tons with 10% tolerance, and the delivery is usually done in ingots only. Now, with regards to the 99.98% quality, which I had mentioned, MCX itself empanels brands, and MCX currently has 7 domestic refined lead brands empaneled for 99.98% delivery. The list of which is, as you can see here, with specific circulars in which they have been declared. What we do and ensure is that all of these brands follow the quality benchmark for the industry with the standard, their chemistry being in accordance with the standard of IS 3717, SPB 99.98, which ensures that the quality is maintained for whatever the grade accepted is. Now to come to the point where this is a brief look into the last 2 years of lead activity on MCX lead contracts. As you can see, the volumes and prices have been very volatile. And over the last 2 years, in fact, volatility has also increased. FY25 to FY26, a 3% increase in volatility. Even the high and low prices per year sees a variation of almost 20 rupees per kg, which is quite high, almost 10% of the price itself, which indicates the high volatility. You can also see that in the near-month future prices, there are frequent price reversals. The price suddenly reverses either from the peak or from the trough suddenly, which indicates how suddenly the prices can move. And what are the various factors that impact these prices? These prices are impacted with the international spot market premium, the forex exchange rates, if there are any economic events such as any financial crisis or any expected industrial growth, or even any commodity specific events such as any new production facilities, mine closures, and so on. The other factors that also affect it include FTAs, which ensure that lead is imported duty free into the system, as well as the scrap collection rate, because India's scrap market or recycling market is quite large in lead, with well over 50%, as has been already mentioned. Now, in MCX itself, overall, the participant base has been pretty broadening, with secondary smelters and recyclers also participating in the system, selling forward against scrap procurement. The reason they do this is because MCX prices incorporate all the volatility factors which I have mentioned, like duty, the forex, sea freights, etc. All these factors are already considered in MCX prices, and the prices are, since ex Chennai based, the only factor you have to consider is GST and the freight from Chennai. Similarly, battery manufacturers do layer forward buying, and they integrate this into treasury strategy, as MCX has a marked MTM system where daily MTM is either credited or debited with the participants in the system. Traders and investors also participate, providing the liquidity in the system, and so on. The participant base has been quite increasing in MCX lead. Now, how these participants manage their risk comes down to basically two different factors. One being the hedge ratio calibration, in which case, if you have committed orders, you fully hedge your orders, while in spot procurement, you hedge as and when you purchase the metal. Similarly, for layered forward, second option is to layer forward buying, by spreading your purchase across multiple expiries so that the single point price reversal, which I mentioned, does not impact your bottom line and does not impact your margin. Let's look at this with a very brief example, very small example. Let's say as a company, you want to import 10 tons lead to conduct your routine production, and whatever the finished goods is, you will sell it in the physical market after a month, after 4 weeks, as per the market rates at that time. So what you will do is, let's say on the first of the month, you buy the raw material from physical market at 200 rupees per kg. So what you will do is immediately take a sell position, the opposite position of your physical market in the futures, in the MCX contract. What this does, why this matters, why the opposite position matters, is because typically physical market and futures prices, price and future prices both move in tandem. Either both will decrease or both will increase. In which case, if you face any gain or loss in the physical market, it will be offset by the gain or loss in the futures market. This can be looked at in a brief example as we can see here. Let's say you buy at 200 rupees per kg in the physical market. So what you will do is you will sell in the future. Let's say it is going at 201. Now let's say when you process the metal and whatever finished good is produced, you decide to sell it. Now let's say the price has fallen by 7 rupees, in which case in the physical market you will sell at 7 rupees less. But because you had taken a sell position in the futures contract, you will also gain that 7 rupees in the future, basically offsetting the loss and ensuring that your 200 rupees price, the initial price at which you had locked in, is maintained. And this works both ways. This happens also if the prices increase, in which case, while you will sell at a higher price in the physical market, you will also kind of lose it in the futures market, and the net is offset altogether. So your lock-in purchase price of 200 stays maintained throughout your transactions, throughout this. This in a way ensures that your business is not exposed to any price volatility, and your margins are protected throughout the transaction and throughout this process. There is another factor that comes into the picture here, which are the secondary lead operations and the basis risk factor. The basis risk is basically the gap between the MCX price that you can hedge and actual scrap procurement that you can face, which was also highlighted in Ronak's sheet, where you could see that scrap prices are typically 70 to 75% of lead MCX price, but they can vary, they can change, and this can impact your margin and affect it. So even a partial hedge of the quantity that you can procure from that scrap is still a better way to manage your exposure. This is a brief graph of MCX benchmark prices benchmarked against global LME prices. So what we have done here is that we have LME price plus duty, which is typically how final prices are calculated for lead, compared against MCX near-month future over the past 1 year. And as you can see, the prices have been moving in tandem, either at sometimes being in 3 months, sometimes being in discount, but for the most part being in tandem with each other. This basically, in a way, when you look at it, if the spread widens, you can assume that there is some domestic tightness or there is some scrap shortage, maybe there are some smelter disruption, something along those lines. If the spread narrows, there are somewhat surplus condition, you can expect some price relief in a way, which is what this basically graph is suggesting. Lastly, how this particular part matters for India's context, why this matters, because of the demand calendar, which, as you can see, for UPS and telecom tower battery demand, it will stay relatively stable. But for remaining users, there's typically a monsoon slowdown during May to June, July, August period. It is then replaced with a spike, which improves the activity further on our MCX contract. This seasonal demand is embedded, is captured in our forward curves and can be tracked clearly for getting an edge for tracking. The key takeaways for this session is that MCX lead has been focusing on deepening by empaneling new brands, focusing on domestic producing brand, and ensuring the quality of 99.98%, which enables them for delivery. Basis risk is the second takeaway for secondary smelter, especially because of the price variation that can happen due to scrap shortages due to the ongoing Middle East war. So even a partial hedge would be better than none. And currency, third takeaway would be the currency risk of the INR USD, even if you go via LME route, in which case not hedging currency would not work because it would be an incomplete strategy. the currency, just the currency movement can impact how expensive or cheaper the metal you buy is. MCX prices account for both of these as it gives a direct price in INR. And lastly, the scale at which India's lead market is, it requires a domestic benchmark, and MCX provides that. Lastly, these are some important links that would be relevant to lead producers. Regarding 99.98%, there is an empanelment process available on our website, which you can go through. The link is given here. And there are some relevant fees for it, which are also have been reduced later on, lately in April 2025. And lastly, you can also go to the lead product page on our website. So you can go into how our contractors, what are the details about it, and so on. These are some brief do's and don'ts regarding commodity derivatives that you already know. And lastly, these are the MCX Investor Service Centers Pan India that you can contact or which you can reach out to, so that if you have any questions or if you wish to discuss more, you can reach out to them and we will address those concerns. Thank you very much for this for your time.
Thank you, Mr. Ameya.